Let's take a look at MTUM, the iShares Momentum ETF, and QQQ, the NASDAQ 100 ETF. Either one of these funds could represent the large growth portion of your portfolio, but they are two vastly, distinctly different funds with different strategies. So let's take a further look at them to help you ultimately decide which one is right for your portfolio. And of course, towards the end, I'll share my thoughts and opinions on these two funds. Here we go. Right here on Morningstar, we can see both of these funds are clearly in the large growth region of the stock style chart. This is MTUM, and here is QQQ, also clearly planted in that large growth region. But I said there was a vastly and distinct difference between the two of them. Let's talk about that. MTUM is a momentum factor ETF, as the fund's name implies. No secret there, right? So what this fund does is it basically looks at the S&P 500 and then picks the highest quartile of stocks based on momentum. So it's getting exposure to about the highest 25% of momentum stocks based on their proprietary metric in the S&P 500. And I say proprietary metric, iShares, the fund issuer for momentum, I've looked through their fund documentation. They do not disclose the exact methodology of their fund other than to say they're, using momentum weightings of this and this and this, but really not giving precise details so nobody can replicate the underlying strategy of the fund. But fundamentally, you were getting exposure to the highest 25% of momentum stocks in the S&P 500. I must say, broadly speaking, in the momentum world, this is not getting very narrow exposure to momentum like a fund like, say, QMOM, Quantitative Momentum by Alpha Architect, that looks at, I think, either the Russell 2000 or Russell 1000. So it's getting a larger universe of stocks to select from and weights them according to momentum. And then narrowly only holds, I think that fund only holds like 40 or 50 actually holdings. So yeah, this one here is getting broad exposure to momentum, not deep exposure. So it's still holding. If we look at the portfolio and go to holdings, we can see it's got 123 holdings. That represents about 25% of the S&P 500. Now, it's not weighted according to market cap, obviously. So that is a big difference, right? Keep that in mind. This is not market cap weighting. I think I made that clear when I said this is a momentum factor. But largely, it's going to have exposure to some of the big names that market cap weighting does. Just looking at it here, who's some of the surprises? Well, I think Costco being up there, Eli Lilly and Co. I don't think that's a top 10 holding of the S&P 500, and probably Thermo Fisher Scientific also is a top 10 holding. That's pretty unique, and that's quite different from the actual weighting of the S&P 500. And also, I should say this ETF changes its holdings quarterly. So the holdings are constantly changing, or not constantly, but quarterly changing to reflect the current momentum. Now, QQQ is the NASDAQ 100 ETF. This is a market cap weighted ETF. So it's market cap weighting the NASDAQ 100 index. So this thing is not changing its holdings. Whereas quarterly, MTUM is changing its holdings. So the big thing to take away here is momentum is a momentum factor ETF. It changes its holdings to chase the momentum. QQQ is just a market cap weighted index fund, essentially. All right, so we've been talking a lot about holdings, so let's look at the holdings a little bit deeper. Actually, before that, let's go to performance. I know everybody likes to look at the performance, but we have to keep in mind past performance is not predictive of future results, or whatever that saying is that's at the bottom of basically every fund statement. So if we put this on the interactive chart, and let's go to the MTUM interactive chart, just because MTUM is not as old as QQQ. So we can look back a little bit longer. TikTok Morningstar. There we go. We will put QQQ on the chart. ETF Invesco QQQ Trust. All right, there it is. We'll set it to max, and we can see the difference. All right, over this period of time, since MTUM was launched in May 1st, 2013, clearly QQQ has been on a run-up, and it has outperformed MTUM. But, there's some big portfolio differences here. Let's just put S&P 500 on there. Let's get away from the growth. And this is particularly to compare MTUM. All right, so here we go. We can see MTUM has slightly outperformed the S&P 500, not much. So it's going to be very similar to the S&P 500, even though it is a momentum factor ETF. It's still holding 120 stocks of the S&P 500, and largely it's probably going to hold the bigger names. I don't really know if it's going to hold the smaller names. It looks like it can hold the smaller names, I guess is what I'm saying, but it seems like in their methodology, it seems like in the MTUM methodology, they do weight heavier towards the larger stock. So it seems like even though there is a momentum rating in there, and that is the primary basis for stock selection, it seems like they are weighting them based on market cap. It seems like it's got a little bit of like a market cap twist to it. And we can see that, based on the largest names in the actual fund holding. We'll take a look at that in a second. A big thing to point out here, QQQ has radically outperformed S&P 500 and MTUM. MTUM has slightly outperformed the S&P 500. So if we go back, I was talking about the fund holdings of MTUM. And when you look at the fund holdings, one thing that stood out to me is these are mostly bigger names that are in there. That's performance. We want to go to portfolio. Yeah, Tesla, Microsoft, Nvidia, JP Morgan, Bank of America Corp, Eli Lilly and Co. has a pretty big market cap. They're certainly in the top 50. I know Adobe is in the top 50. I think, basically all of these are in the top 50. So it seems like MTUM, although it's, primarily screening for momentum first, is weighting and is leaning towards a market cap weighting. Right? I mean, I don't want to keep making that comparison and make it seem like they're market cap weighted or they do the same. No, they're not. But they're not really a deep factor fund like QMOM, Quantitative Momentum by Alpha Architect. But that is not a large growth ETF. That primarily, I think, gets a lot of exposure to mid cap. So yeah, keep that in mind with their methodology and the broadness of how they apply the momentum factor and what is probably a little bit of a market cap weighted tilt to their portfolio. They're going to perform very similarly to the S&P 500 as we saw on that chart. Now, QQQ, let's take a look at that. We'll go portfolio on this one. And they've got 101 holdings, NASDAQ 100 index, of course. And then we can see their names up here, market cap weighted. Holy shit, Apple equals 11.85, Microsoft equals 9.94. So between the two of them, you've got almost 22% exposure to Apple and Microsoft. So you've got a lot of exposure there. One thing that might be interesting too, instead of QQQ, is an equal weight NASDAQ fund. I don't know if that exists. Probably does. But yeah, you've got a lot of exposure to it here. Now, if we look at the portfolio sector exposure, we can see technology, 47.6%. Communication services, 18.6%. So this is heavily weighted in tech and communication services. It's kind of implied, and if you're at this video, you probably already know that the NASDAQ is basically a big tech index. Whereas MTUM at the moment is only holding 33.62% in tech. And right here, look at this, financial services, 25.38%. That's a very big exposure to financial services at the moment. Clearly, financial services seems to be where the momentum is. But that's what's cool about MTUM is you can fundamentally, or you can't fundamentally, it's fundamentally going to go where the momentum is. So the holdings are constantly going to change and its sector exposure is going to constantly change. And mind you, I say constantly changing, it's only changing every quarter, but that's still, well, I mean, I guess that's a lot more frequent than a static exposure. So what else can we point out here? Fund expense ratios, I think MTUM is 15 bips, so it's a pretty low cost fund. So low cost fund at 15 bips. Not quite as low cost as like S&P. And then QQQ, I think is 20 bips. Load it up. Where is it? There it is. Yeah, 20 bips for QQQ. So they're both relatively low cost. I would say if you're looking for large growth exposure, I don't think that you should balk at either one of these expense ratios. So what are my thoughts on it here? Where should you invest your money? Well, one thing I clearly have to point out here is that QQQ gets a lot of exposure to tech, like only exposure to tech, right? So when you invest in QQQ, you are basically making an investment or forecasting or emphasizing your conviction. Gosh, how many ways can I say this? You are basically, saying, hey, I believe that tech is going to keep growing. And now when we look at, I put this into Portfolio Visualizer here. I put the QQQ NASDAQ 100, next to the S&P 500. And we clearly have seen in that other chart too, that the tech sector has just been on a rip roar for basically the last 7 or 8 years. And we can see how the tech sector performs, or I say tech sector, but I'm talking about QQQ, going back to 2000. So it's kind of bubbly, or it had that bubble in 2000, had more of a prolonged drawdown than the S&P 500, and then it explodes back up. So it gets these real periods of explosive growth. Now, here's an interesting comparison I haven't done yet. What if we just started with $1,000 and invested $1,000 per month in each one of these S&P 500? I'm not using MTUM because MTUM only goes back to like 2014 or something. So we can do initial amount $1,000, cash flows, contribute fixed amount $1,000, inflation adjusted. I'm going to select no, just because I like looking at the data in a absolute manner, and invest $1,000 monthly. So here, when you look at this, you can clearly see the bomb return of QQQ over this time period, basically doubling the S&P 500. When you're doing that, if we go back to, let's just look at it through the 2000s. That would be an interesting period, the lost decade. So we'll go 2000 to what is really 2009, a 10-year period there. And even despite the bubble, investing in QQQ outperformed the S&P 500 through that period of time. If we set it to, 2010 to today, the last 12 years or so, it's going to be a rip roar there on QQQ. Now, of course, what's the volatility and downside? Well, let's set this back further here. Setting it back further, is that with $1,000? Yeah, we looked at that already. We looked at the total returns on it here, 1 million versus 2 million over this time period. Standard deviation though, here we go. Max drawdown, 23.26%. I was thinking max drawdown here, but the standard deviation at 23.26%. Max drawdown, 81.08%. So you get a lot higher drawdown. So, you ultimately might want to factor into your decision here between MTUM and QQQ. Let's go back to the topic, MTUM and QQQ, not QQQ and S&P 500. Right? Do you want exposure to the momentum factor? Well, yes, if you want exposure to the momentum factor, MTUM is the way to go. Do you believe that the tech sector and communication services are going to continue this rapid growth? That's really something that only you can decide. Certainly, tech sector has been very bubbly, right? So as we can see here, tech sector has kind of exploded as represented by QQQ. So, maybe it's at too high of a valuation. That's something to keep in mind. The other thing, too, to consider is, what is your time horizon? Okay. If you've got a long time horizon, like we can see here over 22 years, investing $1,000 in QQQ in the NASDAQ 100 has been a pretty resilient bet. And I think that is more likely to persist. If you can hold, if you can, how should I say it? If you've got the time horizon, you can have the conviction to it. To me, it seems like QQQ is more of a safe bet. Investing in innovative technologies, investing in the NASDAQ 100, you're going to have some drawdowns, some dips, some downside, but over time, it seems to keep going up, and the trend seems to be that new technologies are where the rapid growth is in the market, and there's newer technologies, or I shouldn't say newer technologies, but there's new technologies coming out more rapidly. So there's a lot of growth here in the NASDAQ. And if you can withstand the drawdown, and the standard deviation or volatility, I think that is probably a sound bet. Whereas, if you just want to possibly catch some upside of large growth, but not have the huge variation from market cap weighting, then maybe S&P, or not S&P 500, but MTUM is for you. And I'm thinking S&P 500 because it kind of closely follows the S&P 500. One other thing I wanted to point out, which certainly drives my bias to QQQ and the NASDAQ 100 index, is that the performance of the momentum factor has been dwindling in recent years. And here we can see this data which shows the performance of the FAMA French momentum factor compared to the S&P 500 and Russell 1000 decade by decade. And we can see in the 60s and 70s there was a huge difference in performance between the momentum factor and the actual index. Momentum factor, just absolutely blowing everything out of the water. And then in the 80s and 90s, things get closer. And in 1992 is when FAMA and French published their three-factor model and putting momentum into the academic literature. So at that point, it kind of became broadly known that, hey, momentum outperforms. But I would wager that, the majority of the institutional investing world had clearly identified momentum before that. Back in the 70s, Richard Dennis in the Turtle Traders, were doing their thing in the commodities future markets. That was clearly momentum trading. So clearly momentum was going on, and there were momentum investors and momentum investing strategies back then. But then in the 80s, more people probably caught wind of it, potentially because of the Turtle Traders, right? And then in the 90s, it was actually published in academia. Most of the cutting edge and innovative strategies are developed in the private world first. They get all the big brain power, they've got the money to retain the brain power, and then they get published in academia. So, let's just assume that in the 80s, more people started investing in momentum and kind of started arbitraging that away. And we can see the difference is pretty narrower. In the 2010s, it's very narrow, hardly any difference, hardly any outperformance in the momentum factor. So potentially, and I quite frankly believe that the momentum factor, at least on individual stock selection, has largely been arbitraged away. And because of that, I think I might have a bias towards the NASDAQ 100 index. So guys, what do you think? Where are you going to invest your money? Let me know in the comments below. MTUM or QQQ? Let me know your thoughts. I'm signing off on this one.